Good morning, ladies and gentlemen. Welcome to the show. Glad to have you guys here on this Tuesday, the 25th of January, 2022. Thank you for tuning in. Now, you know what? Let's get started right away. Let's open up the charts right here. The IMF, International Monetary Fund, slashes global GDP growth to 4.4% in 2022. Warns of aggressive Fed tightening. Yeah, that's right in front of us. The Fed, they haven't done that much yet. They've only made one cut to their bond purchase program of $30 billion. I think their bond purchase program is, if I remember right, it's $120 billion. So they're at $90 billion. And they haven't raised interest rates yet. They really haven't done anything. Why is there so much volatility in the markets? Well, it's like this. The markets have an elastic effect. And what's happened is with this, the biggest stimulus program probably in history is just getting really trillions and trillions of dollars they dumped into the system. Had an effect on the markets, It's a slingshot effect. It's kind of like an elastic effect. The markets are works almost like the elastic on a slingshot, You pull it back one way really hard and it snaps back the other way really hard the other way. It's a momentum. It overshoots. The markets are right now from momentum are up in dizzyingly high heights. They're like an elastic band that's sprung the other way too far and it wants to spring back again. It's that elastic. I'm calling it an elastic effect that the markets have, and this is what's creating the volatility. Even though the Fed hasn't done a lot, but the Fed is planning to do a lot. They just haven't done it yet. And so they're warning, the IMF here is warning of aggressive Fed tightening. It says, looking for more proof that the global economy is slowing fast. Oh yeah, it is slowing. It's slowing down really fast. Then look no further than today's latest quarterly World Economic Outlook publication from the IMF, which slashes its global economic growth forecast for 2022 from 4% to 4.4% as the COVID-19 pandemic enters its third year, citing weaker prospects for the United States and China along with persistent inflation. Downgrade was across the board, with the Monetary Fund slashing its GDP forecast for the United States, Eurozone, UK, Japan, China, and emerging markets. The IMF also downgraded its view on global trade from 6.7% to 6%. So, what we got here is the whole world is slowing down. At the same time, the Fed's tightening. And China's undergoing a massive real estate debacle with their real estate developers. Like the first one that was given problems was Evergrande, and now it's spreading out. And now they're stimulating. And so things are bouncing back a little bit in China, but only from stimulating. Let's take a look now at silver price today. It's off 25 cents today at 23.74. But it looks like it might end today more closer to the board. It looks like that 25 cent, we could see most of that go back to what it was, before the end of the day. Could rise a little bit higher. We're looking at gold right now. We're looking at 1845, and it's up $2.20 on the day so far. So I think silver will make a little bit of a catch-up here later in the day. Let's take a look now at cryptos. And we're looking at 1647. Let me refresh the page. 1646. So it ain't going nowhere. Bitcoin price is staying at 36,601. We're in a bear market right now on cryptos. And this is almost like a game that's being played right now. The Fed's going to keep tightening until they create a massive problem in the financial system, and then they're going to turn around and then they're going to start to stimulate again to try to get out of the mess that they created. It's as simple as that. But on this side of it, we're going to keep heading into this mess that they're going to keep creating until the mess gets big enough where they have to fix it. It's a silly game that's being played, and it affects all of us. But what can I say? This is the way bureaucracy works. They work to enrich themselves, and they work to the general population out there. They're not on our side, especially the Fed. They are quite literally going to keep pushing the envelope until they get to the point where we're starving. We will, in the end, we will be starving, quite literally, if the Fed stays in action of what they're continuing to do. They're absolutely destroying the middle class. There's no two ways. There won't be a middle class. And when I say middle class, I'm talking about all of the people that are kind of in between. Like, they're not poverty, but they're not rich either. And most of the people that watch my show are middle class. I would consider myself to be in the middle class, lower middle class, but still middle class, and upper middle class. I consider it, those are the people you say, well, they got some money, but they're still not rich. They just, they got a really nice house maybe and nice cars and everything else, and they might work as a doctor or something like that, have $1 million or $2 million in the bank or whatever. That's your upper middle class kind of. And then you got your lower middle class, which is where most of us are, and we're getting by, just getting by, just squeaking by, just getting our bills paid. And then you got your people who just aren't getting their bills paid, but they're still middle class. They're not on the street, And then you got the people that are on the street people, and they're poverty. They're not really middle class. They're kind of like poverty, you know what I mean? They're homeless and stuff, I'd almost include them in the middle class too, if depends, how bad their situation is. You could classify them as poor if they anyway. They're destroying all those classes. They're actually destroying all of us, all the way up to the rich. And then the rich, they're supporting them. They're allowing them to get into the cheap, easy, free money as much as they want, if you're on that side of the fence. So what this is this is a discrimination against the poor and the middle class, and it's a big boost for the rich, giving them the ability to borrow money at almost zero interest rates and extending credit to them. And that's where it starts, and that's where it stops, because that's what's causing this division between the middle class and the rich. And that's growing bigger and bigger and bigger, is the fact that they're feeding them. The rich. They're feeding the rich, and they're starving the poor by setting up conditions out there so that business cannot thrive. Small business, small enterprise cannot thrive. The only thing that can thrive is these big corporations. And that's because they got a fix with the politicians, with the political structure. It's a corrupt system, completely corrupt. And that's why it's going down. It's going down because it's not just. It's unjust. It's an unjust system that's running right now. And there's so much corruption within it. And that's why it's breaking down. Little bit by little bit, it's breaking down. And it's breaking down very slowly, so it's hard to see it breaking down. But in the final stage, it's going to go fast. It's going to slide fast. It's kind of like one of those things, if you're trying to move something and you budget and you budget and you budget, and it just doesn't seem to want to budge. It's only moving a little tiny bit. Then all of a sudden it just it just goes. It's all at once. When it finally slides off the end of the bluff. It's just, there she goes. And that's the way with this system. It's slow, and then fast at the end. And that's what you can expect, and we're almost to that stage where it's going to start to move quickly. You got to watch out. Okay, so we're going to move on here. We're going to take a look at the stock market today, Dow Jones specifically. And you know, it was down like 800 points or 700 and something points just a few minutes ago. Now it's down 395. It's cut its losses in half so far, but it's doing that. It's hopping up and down like a yo-yo. It go down 1,000 points yesterday and then make up and then be on the plus side at the end of the day, you know. So it's down 395 points right now. 33,858. And really, the markets are moving down not because of what the Fed's done. The Fed really hasn't done that much yet. It's the prospect of what they're going to do. They're going to cut off the money spigot. And this is what's propped the markets up. And this can take them down too. But they haven't done it yet. And so you want to see some big moves down, because they're not going to stop cutting off the money spigot until we get the big moves down. So the big moves haven't come yet. The markets are still buoyed, as far as I'm concerned. I mean, anything over 30,000 is like, you know, we're still at 33,858. It's got a long way to fall. I mean, it could fall. If they didn't stop it, it'd be crushing what it would do. Let's take a look now at crude oil at 83.81. Okay, so crude oil is up a little bit, 50 cents on the day, or almost 0.6 of 1%. Let's take a look at the move index, 83.77, and it's starting to creep up a little bit. Let's take a look at bonds and rates. Now we're seeing rising yields today, 1.748 on the U.S. 10-year, so 1.74 on the U.S. 10-year, and the U.S. 30 years at 2.09, and they're up 1.3 basis points on the 10-year. It's up, and not quite 1 basis point on the U.S. 30-year. I think these yields are going to stay fairly well in check on the long end of the yield curve until they do the next cut, and then I think that the 10-year is going to start to head up toward 2% when they do the next cut, which would be another $30 billion. I'm not exactly sure. It must be pretty soon now. We'll do that next cut. Let's take a look at the dollar index, which is at 96.14 and rising today. So there we go. We're all set for a market crash. And I'd almost say there's a very, very high probability of us having an actual market crash now at this point. Once the Fed really starts to do what they say they're going to do, and they're going to do it until they get the market crash. I don't think the market crash is going to last very long. And then the Fed's going to turn around because they got to support the system. They can't have all the bubbles pop, especially things like the real estate bubbles and stuff. Well, you see China's starting to support their system with cheap, easy money because their real estate market was getting ready to pop, and they seem to take a hard line until it starts to pop. And that's the way with over here in the West. They're going to take a hard line until it starts to pop, and then they get scared, and then they back off and support things again. And that's what they're going to do here, you know, because it seems like they have to create a problem in order to fix it. So right now the Fed's creating a problem in order to fix the problem they created. And the things just get worse and worse and worse, and we just keep moving toward inflation. And listen, guys, it ain't going to stop. Inflation ain't going to stop. If you look at the overall trend since going back to 1913, and they've lost like 98% of the value of the purchasing power up till now, and it's taken all these years, taken over 100 years. That's a trend. It's a long-term trend, and that long-term trend is not going to stop. And the same way with bonds. If we look at the 10-year here, let's take the 10-year, look at it specifically. Okay, here's today, the 10-year. It's up and down, it's all over the place. You don't see any trends. But now if I click the chart here, it says all. So it's encompassing a number of years. Suddenly you see a chart trend here. What is it? Now it's going back all the way back into the 1980s. Okay, look at this trend. What is that trend? descending. Yeah, it's got little ups and downs, boop, 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 up and down, up and down, up and down, up and down. But overall, taking a look at it since the 1980s, it's a descending trend. Now, this is the way with the dollar losing value. It's a descending trend. It's taken a long time, over 100 years. This chart's going all the way back into the 80s, and it shows a descending trend on the U.S. 10-year. It's going to continue. But they're down near zero. What's going to happen? Negative interest rates. That's what's going to happen eventually. It's going to take a little bit for it to get here. But that trend is that the Fed's not going to raise interest rates, not substantially. If we look at this trend line, about the maximum they could ever raise those interest rates on the U.S. 10-year would probably be about, I don't know, 2.5%, 3%. So there's their hard line that they can't cross. And ultimately, we're going to be looking at rates closer to zero, because they'll have to come in and fix it if they let the rates go too high. And ultimately, the rates are going to be lower than they are now. I mean, we're probably going to be looking at sub 1% U.S. 10-year rates, probably within about a year or two. A year, maybe, or I don't know, maybe less. Because it's going to follow this trend line. It's not going to break this trend. And this also shows the pinch. This chart right here shows you, it's almost a direct correlation to the amount of leverage that's in the system. Because as this falls over the years, as this is falling, the leverage has been increasing in the system. And this is why they can't let interest rates go up, because the system's too over-leveraged with debt. Purge the debt and they could raise the interest rates. You know? Anyway, let's take a look at the U.S. dollar index to finish off the day at 96.17 and rising today. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode, and you guys have a great afternoon. Bye-bye.